Let's try and clarify that, because I saw that report when it came out a few days ago. There was a headline, it was market weight, and then it became overweight. So to clarify, it's market weight, and what does that mean exactly?
Yeah, that means that we are recommending that investors hold their weightings at the benchmark for China. Previously, we were underweight. We've been underweight on China for a year, which worked very well for us given how poorly the market had done. But we see better times ahead for China. It's not yet a super strong story. We're not yet going overweight, but we think that there's policy support and the valuations are very appealing.
Valuations where, though, within China? Because I can pick one sector and I can say it's very expensive. I can pick another one and say it's very cheap. Valuation dispersion is quite a theme to, I would imagine, that investors need to sort of parse in their heads this year.
Yeah, there is a wide dispersal within China. The cheapest sectors would be the banks, the real estate companies, and the internet stocks, whereas, say, the EV companies, the new economy companies outside of the internet space, along with consumer, are more pricey. But I think that you can find enough interesting stocks to establish a benchmark weighting in China.
Okay, and when you say tech, what do you mean specifically by tech?
So those would be the hardware names as opposed to, say, the internet stocks. The hardware names have not faced any of the regulatory issues that the internet stocks have. As a result, their valuations have held up quite well, and their businesses have been doing very well also. And that's why their valuations are richer than, say, for the internet stocks.
And the call on consumption, that's also a fairly broad theme. Dan, could you, I guess, elaborate a little bit more on the consumption play there?
Well, I don't think that there is, broadly speaking, a strong consumption outlook in China, but there are a lot of listed companies that actually are doing much better than the consumer, broadly speaking, is. Sectors like sports leisure wear or beverages, where you've got good growth despite the fact that the headline consumption numbers aren't terribly exciting.
Now, Dan, I'd like to ask just the overall outlook on the onshore, the A-share market, because if you're a dollar investor, you're also faced with an exchange rate that's actually moving against your preference. I mean, the currency is getting kind of strong, and if you're not hedged, those returns basically disappear. How would you advise dollar investors right now?
Well, I think that the exchange rate will not be a big issue for dollar investors going forward. We're expecting that the renminbi will be fairly stable over the coming year.
Understood. Okay, let's pivot and have a look at other markets. So Japan, you've downgraded that. Why?
Typically, Japan underperforms emerging market Asia if you've got inflationary pressures on a global basis, and we clearly have that now. As well, Japan tends to lag if the dollar isn't strengthening, and we think that the dollar on a, say, 6 to 12 month view is going to be having a weakening bias, although the Fed is clearly more aggressive than other central banks globally. The current account deficit in the U.S. is unusually wide right now, and that should place a drag on the dollar, which typically would be bad for Japan's performance relative to the rest of Asia.
Your other topic in the region is South Korea. You've taken that up, if I'm not mistaken, almost 2 steps there. You're overweight. Tell us why and where in that market do you want to be?
Well, South Korea has underperformed the rest of the region quite significantly over the past year, and year to date, it's been unusually weak. But if you look at the fundamentals, it's still a pretty good story. We think that DRAM is going to have a good year this year. CapEx is down, and that typically is a good lead indicator for pricing for DRAM. We think that the auto sector is going to do well globally, and that Korean autos will do better than their global peers. The economy and exports are actually doing quite well, and it's not being reflected in share prices yet.
Dan, final question. The market in Manila yesterday, interestingly, closed at pre-pandemic levels before the first case was confirmed. You've trimmed your overweight in the Philippines as a function of what?
That's largely due to the Fed rate outlook. Typically, Philippines lags in an environment of rising global rates. Otherwise, there's a good story in the Philippines. The bounce back from the pandemic ought to be strong, and it's a good structural growth market. But we think that given the global situation, it's time to trim a bit.